This type of investment fund, or ETF, is an embodiment of a collection of securities, a unique financial instrument that provides investors with a great degree of flexibility and diversity. To understand the nature of ETFs first, we need to acknowledge their structure. The core of this type of investment fund is formed by a variety of securities. These could include, but are not limited to, different types of stocks, bonds, commodities, or a mixture of these. The beauty of this type of investment fund lies in their versatility. Instead of investing in individual securities, which could be risky, you're investing in a broad spectrum of assets. This wide distribution mitigates the risk associated with investing in a single stock or bond. This diversification of investment is one of the major benefits of this type of investment fund, as it allows investors to spread their risk across a variety of sectors, industries, or countries, depending on the nature of the ETF. Unlike mutual funds, which are only traded once a day after market close, this type of investment funds are traded on the stock exchange just like regular stocks. This means that throughout the trading day, their prices fluctuate based on supply and demand dynamics on the exchange. This feature provides ETF investors with the ability to react quickly to market changes, an advantage not available to mutual fund investors. Moreover, this type of investment fund aims an advantage not available to mutual fund investors. Moreover, this type of investment fund aims to replicate the performance of a specified index or sector. This means that if the index they're tracking goes up, the ETF's price will also rise in tandem, and vice versa. This is an appealing aspect for those who desire to match the market's performance without the need to select individual securities. Furthermore, this type of investment funds carry a certain level of transparency that other funds do not. It's not uncommon for ETF providers to publish their funds' holdings of this type of investment fund that makes them offer flexibility in terms of investment strategies. They can be used for buy and hold strategies, for hedging, for achieving exposure to a certain sector. Such funds generally track the performance of a specific benchmark index. Imagine wanting to invest in the S&P 500 index. Instead of buying shares from each company, you can buy such a fund. A fund replicating the S&P 500 has similar securities. If the index rises or falls, the fund follows suit. These investment vehicles, much like regular stocks, can be traded during market hours. This offers flexibility for portfolio management. With the ability to buy low and sell high throughout the day, these investment vehicles maximize profit potential. These types of funds, or ETFs, provide an efficient method to diversify investments. They represent a wide array of securities, enabling risk spread across different securities, reducing potential impacts of market swings on individual securities. Investing in these types of funds, which isn't confined to a single company or sector, lowers risk and shields against market volatility. This diversification helps significantly in mitigating risks associated with singular investments. Known as these investment tools, exchange-traded funds generally have lower fees due to their passive management style that tracks a stock index. This results in cost savings for investors, making these investment tools an ideal choice for portfolio diversification while saving on costs. As exchange-traded assets, these financial instruments are highly liquid, meaning they can be bought or sold without impacting the asset's price. They adjust to supply and demand, similar to individual stocks, providing investors with flexibility and easy trading. These types of investment funds are a unique investment instrument, tracking specific benchmark indexes like stocks, bonds, or commodities. Investing in these types of investment funds means buying shares of a portfolio that replicates the yield and return of its native index. Many of these types of investment funds provide regular income through dividends, derived from the earnings of the tracked securities. These financial tools are popular for their simplicity, liquidity, and flexibility. They're key in portfolio building, targeting sectors' market trends. However, they carry potential risks. Therefore, thorough research before investment is crucial. These types of investment vehicles typically follow a passive strategy, replicating the performance of a reference index to mirror benchmark returns. This is unlike mutual funds' active management that relies on market research. The passive approach of these types of investment vehicles curbs costs tied to research and frequent transactions, minimizing active decision-making and costs.